Today we're going to be looking at Chapter 10, where we're going to learn how to calculate depreciation. So at the very beginning of this term, you learned how to record the journal entry for depreciation, and I told you later on at the end you're going to learn how to calculate the amount. So there's 3 methods to calculate depreciation. So we're going to start with the first one, straight line. Now straight line depreciation is primarily used for financial statement purposes, and here's the formula. We're going to take the cost of the either equipment, furniture, whatever the fixed asset is. We're going to subtract something called a residual value, sometimes also called a salvage value. This is what the worth of the asset is going to be at the very end, what we could get for it. Not exactly what it's worth, but what we could get for it. Kind of like trade-in value is residual value. And then we're going to divide it by an estimated useful life of the asset. So here's an example of how we can apply this formula. So we have a piece of equipment that costs $24,000. That's our cost. And it has a residual value of 2. So we're going to subtract out 2 because we are not going to depreciate past that $2,000. We're going to only depreciate the 24 minus the 2. And then we have an estimated useful life of 5 years. So this gives us a depreciation expense every year of $4,400. Per year. So we're going to record depreciation of $4,400  5 times. So at the end of every year, we're going to debit depreciation expense for $4,400, and we're going to credit accumulated depreciation for $4,400. Now what's going to happen on the financial statements is on the balance sheet, we'll have a $24,000 asset that we purchased. And then at the end of the year, we're going to record debit to depreciation expense, credit accumulated depreciation. So depreciation expense is going to be on the income statement, and accumulated depreciation is going to be that contra asset that is over on the balance sheet. Okay? So one concept I want you to know at this point is what is the net book value of the asset after we've depreciated it one time. I like to abbreviate that as NBV. So the net book value is going to be the asset cost minus the amount of accumulated depreciation up to that point. That's the net book value. So in this, after year 1, we have 24 minus 4,400, our net book value after year 1 is going to be 19,600. Okay, well then what we'll do is after year 2, we'll record this same entry again at the end of the year for another $4,400. Well, our equipment is still going to be, and it's going to remain at $2,400. And then now we've got $4,400 on this year's income statement, and we're adding to the $4,400 that was already on the balance sheet another $4,400. So we now have accumulated depreciation of $8,800. So our net book value after year 2 is going to be $15,200, which is the cost of the asset minus accumulated depreciation. Let's do one more year. So year 3, we're going to record depreciation expense again. We still have our equipment sitting over here on our books at $24,000. We're adding another $4,400 to the $8,800 balance. So now we have $13,200 in accumulated depreciation, and then this year's depreciation expense. So now our net book value is $10,800, which is $24,000 minus $13,200. So you can see that over time, as we depreciate the asset, net book value is going to go down. Net book value will never decrease past $2,000. Once we get to $2,000, there will be no more depreciation, and that will equal its residual value. So ultimately, accumulated depreciation will end up being $22,000 after year 5. If we do this 2 more times. Okay, so that's the straight line method, and we also are just discussing net book value. So here's our second method, double declining balance. I like to abbreviate this as DDB, and this is used for tax purposes. So the first thing that you need to do with double declining balance is calculate your straight line rate. So your straight line rate is going to be 1 divided by the estimated useful life. Well, in the previous example, we used 5 years as our estimated useful life. So that makes our rate for straight line 1 divided by 5 at 20%. So we depreciated 20% of this asset every year. Well, so now that we have the straight line rate, we can come up with the double declining balance rate, which is 2 times the single rate. So our double declining balance rate for a 5-year asset is going to be 40%. Let's try 2 more examples. So for an 8-year asset, we would take 1 divided by 8. That'll give us a straight line rate of 12.5%. If we multiply that times 2, then our double declining balance rate will be 25%. Last example, if we have a 10-year asset, we're going to take 1 divided by 10. That gives us a straight line rate of 10%. Multiply that times 2 for our double declining balance rate of 20%. So once you have your rate, now you can set up this table. We're going to continue on with our previous example of a 5-year asset that cost us $24,000. And it also has a residual value of $2,000. So this is the same example. We're just going to use a different method to calculate depreciation. So set up your table like this with 5 columns. And you're going to start off with a net book value equal to your cost. Do not take out residual value at the beginning. We take it out at the end when using double declining balance. So what you do is you multiply your net book value times your double declining balance rate. So we calculated that up top to be 40%. So we're going to use 40% all the way through. So 24,000 times 40% equals 9,600. So do that in your calculator and make sure you can get the same answer. So now we're going to calculate, after we do depreciation, what is our new net book value? Well, our new net book value is going to be 24,000, our original cost, or our last net book value, minus depreciation that we're taking currently. So this is 14,400 after the first year of depreciation. So now we start our next line, except this time we start with our new net book value. So our new net book value is 14,400. We're going to use the same 40% rate. So multiply 14,400 times 40%, and you're going to get 5,760. So if you take 14,400 minus 5,760, that is your new net book value of 8,640. So we're going to do it again. Starting with our new net book value, 8,640 times 40% is 3,460. 456. If you take 8,640 minus depreciation of 3,456, you'll get a new net book value of 5,184. Let's do the year 4 times 40%. You'll get 2,074. New net book value of 31,1. Now we're in our last year. And this is where residual value comes in. So you do your first 4 years the same. And then your last year, you have to do something a little bit different because you need a net book value to end up at 2,000. So you have to plug it. So we're going to call this a plug. So what we need to do is only depreciate the amount that is necessary to get to 2,000 as our net book value. So if we're starting off with a net book value of 31,110, and we want to be at 2,000 net book value, that means in the last year we need to depreciate 1,110. So you're going to do depreciation last here and make sure you end up with $2,000 as your net book value. So your journal entries are going to look very similar to what you're already used to, where in year 1, here's your depreciation expense for year 1. So you're just going to debit depreciation expense for that amount and credit accumulated depreciation. In year 2, our depreciation expense goes down. So double declining balance, you'll have a depreciation expense that constantly goes down. It won't remain the same like straight line. So in year 2, we have 5760. So the account names are the same. We just use different method of calculating and different amounts. So your net book value after year 1 is going to be 14,4, and after year 2 is going to be 8640, which we calculated above. So that's your second method. The final method is called units of output. And this is often used for financial statements also, but for unique businesses that operate maybe a manufacturing plant, and they, instead of cost of equipment over estimated useful life, it would make more sense to calculate depreciation on some unit of output. So this formula looks pretty similar to straight line, where we have our numerator is going to be the same, cost minus our residual or a salvage value. But in units of output, we're going to divide it by some type of unit number. Typically, it's going to be machine hours. So here's our same example. We're going to have equipment of 24,000, residual value of 2,000, and then except for this time we're not going to have an estimated useful life, we're going to have machine hours. So to calculate our amount of depreciation, we're going to take 24,000 minus 2,000 divided by the 10,000 hours. And this gives us a per hour rate. So $2.20 per hour that the machine is used. So to calculate depreciation, you're going to take that rate per unit that we just calculated times the number of hours that it was used, and that's your depreciation expense. So let's say in year 1, we get down to the end of the year and we see that we've used this asset 2,100 hours. Well, you take $2.20 times 2,100 hours is $46.20. So this is your depreciation expense for year 1, $46.20. Debit depreciation expense, credit accumulated depreciation. How about in year 2? Let's say in year 2 we used it 4,000 hours. So we're going to take $2.20 times 4,000 hours. That's 8,800. So that's your depreciation expense for year 2. You're going to make that Same entry, debit depreciation expense, credit accumulated depreciation for $8,800. And then in year 3, let's say you used it for 3,900 hours. That works out to be $8,580. And you make the same entry. So when you're comparing all your different types of methods for depreciation, you can see that the end goal is going to be the same. We're going to end up depreciating $22,000 no matter which type of method that you use to depreciate. It's just at what rate are we going to be depreciating it. So in straight line, it's pretty even over the 5 years, but the total amount of depreciation is the same, the cost minus the residual value. That's all we're going to expense. Double declining balance, we get a really high depreciation amount first, and then it slowly decreases over time, but we're still not going to depreciate more than 2,200 hours. And then units of output is going to be all over the place depending on number of hours that we use the asset, but we're still not going to depreciate more than $22,000. So in the end, you will still have equipment of $24,000, and your accumulated depreciation will end up being $22,000. So your ending net book value after you have fully depreciated the asset will be $2,000, and that's what it'll look like over on your balance sheet. So those are the 3 methods of recording or calculating depreciation, and let me know if you have any questions.